Hi, everybody. Our first full week of the new year. Happy New Year, everyone. I know we said Happy New Year last week, but everyone's back. Hello, Shahab. Okay. So, everyone ready for 2020? All right, let's address what's happening here this morning. Start off with Euro. Went with it on this candle Friday. So I could see us continuation move to the upside when I look at the weekly. You know, so far the 50 weeks trying to contain it, but I don't think it will. Your line in the sand is going to be like 110.80, 111, but I think we're going to 113.60, 114 on this move. And like I said, back under 111 is going to be your first sign. Perhaps we get some type of ABC, but I have to go with Euro strength continuing. Really hasn't done anything wrong on a daily basis. In fact, we're starting to get a little bit of this parabola look early on. So perhaps we get some acceleration. I know there's still a lot of bears out there. I mean, bears looking allowed for a bear market rally all the way to 114. Then you start getting through 114 targets that Blake has talked about. Why not 118? And that's just a correction off of the break from last year, let alone when the euro was trading sharply higher. So you could call it new bear market in the dollar. Here's your monthly. Really a very long-term base. You know, I mean, look, we started here. We talk about low volatility this year, but, you know, even back through 2015, 2017, had a 10-cent range for a few years, right? And then we got our first liftoff with the Macron victory and all of this work putting in a higher low. So why can't there be something bigger? I mean, this move was from 160 to 105, right? So 55, you know, let's talk about a 38% retracement of this whole bear move in the euro. You know, is going to give you 20 cents from here. That gives you 125. So not many people talking about this target. Of course, you know, you're always reassessing and taking in new information as it proceeds. This month, last month was a 2-month reversal to the upside. And the only thing that would negate it on the monthly would be closes back under 110.18. Okay, so there's some room here for it to pull back. I think it's going to be, you know, more a negative back under 111 is your first sign that this is just a bounce. But why can't this be A and this be B and have something like this or this from here? Okay, so I really think that if it's going to happen, it's going to be bigger, you know, into after the spring. And let's see, something else I wanted to show you, yields. The 30-year bond held right where it had to. Otherwise, we're on our way for a breakout to the upside in bonds and a breakdown for another trip down in yields. Look at this. There's your daily. So we have this uptrend line here on the daily. Looks like it's missing some data. And here's your 10 years, same type of picture. Under 173, I think we're going to get this one last decline. And then if the dollar scenario plays out this year, I think this will be the last drop in yields as yields begin to head up, maybe even, you know, spike up on some type of dollar problem. Okay, and why wouldn't there be? The dollar will thrive Okay, well, we're going to find out. And we don't know if there's going to be a war. It's highly likely. But the thing that I take away from this whole thing with Iran, um, you know, it has nothing to do with trading. But remember how we used to feel after 9/11 in this country? I mean, it took years and years and years for people to stop worrying about another big attack. Well, you know what? Osama bin Laden and Al Qaeda, I'll use an Obama term, are the JV compared to Hezbollah, Hamas, and the asymmetric network that Iran has all over the world. So, I think that we've crossed the Rubicon there. So I think that you have to, not be only worried about what could happen militarily, but terrorism could come back in a larger way with the networks that they have. I tweeted, if there are sleeper cells in the US, I hope they're all Rip Van Winkle, right? So they sleep another 20 years, and then I'll leave it to you young people to deal with it. Deal? Okay, so I want to take a quick look at oil, because oil's, giving back some of last night's gains. Okay. See this? About to fill the gap. 1, 2, 3. Is it going to go again? And, I think that if you want to trade, I think that if you want to trade oil on a position basis, you just have to be long, okay? And if you want to scalp, you should only day trade in this environment to take reactions if you think there's going to be reactions, or trade with less leverage to the short side in this type of climate. It's probably the same with metals. I think we surpassed, Steve had, I think, 1580 here in the gold. Okay, and silver gapped as well. Silver is actually stronger than gold. All right, so this 3 drive got negated. But if you notice, even with this big spike here on the 4-hour, we're still not confirming. Anyway, I think we're close to at least a reaction here as well in both the precious metals. And one other thing that I wanted to mention before I hand it over to Blake is, this was a nice break in the end, and we talked about being short up here, and then we started talking about support here and support here. This was a pretty negative break, but Blake showed major support. We held it Friday. I think we made marginal new lows. This is your daily. I know I'm tempted to buy it because I want to sell it up here at 109, but that's not the trade. If it gets up here, not that, oh, for sure it's going to get up there, so I may as well ride it up to 109 and make money and reverse at 109. Well, I still do it once in a while. Should probably do it here, but really the correct thing to do is, just wait for rally to sell in case we get one more bout of risk on in the market. And the market really has to hold last week's lows as a line in the sand in the S&Ps. Let me just put a horizontal there. We take out the low from Friday, which looks like we actually held again last night. Then you come up with the targets that Steve and Blake and the team have bandied about 3150. So I want to, your colleagues, they're still very bearish on SPX. Okay. We'll see. I mean, this could turn into a black swan. And curious what Blake is thinking in here going into this week. So without further ado, I'm going to turn it over to Blake. 3150. Yeah, I could see that. You know, I wouldn't call that a crash. Could do that in a couple days. All right, Blake, how are you today, man?
I'm good.
Good.
Happy Monday.
Yeah, happy Monday to you too. Happy New Year, 2020. It's our year.
Yeah. Let's hope we can continue with this the increase in volatility we've seen the last few days. I actually just took my euro long off. So if you guys are, you know, um, well, if you use ForexAnalytix, I was
You had a
had an
pip on,
active
yeah.
pattern in play here at 111.20, 111.30.
Yeah.
I was targeting 112.20, but the problem that we had is had a little false breakout above here. I'm like, it's had a nice run overnight. So, and also if you look at the euro yen has it's a big double top, and we're testing, the breakdown point. So I was like, wow, I'm going to take that euro off as a result. And now, the euro dollar, this is a, where I'm going to look for a pullback. So I was looking for a pullback last week, got it, a good one too, and we got to take advantage of it. So now I'd like to see how we react, maybe 20, 30 pips lower from where we're currently at. So, in this little false breakout here, this is a little alarming to me intraday. And like I said, we've had a decent run overnight. Now, you'd asked about the S&P. Look, I have no real big view here on the S&P, although I still think that we can hit. This is what I said on the week ahead video. I think we can still hit this 3,300 in the S&P if we're lucky. But I'm going to tell you this much: if we get below this upward sloping trend line here, I would not want to be long the S&P.
Where's it come in?
It comes in right now around 3185 roughly. Okay. So about 30 points lower than where we're currently at. Mm-hmm. And like I said, I don't have a view at this point other than, we're in a severe uptrend. It's, I'm not taking a stance. As I had mentioned on the week ahead video, if we rally to 3315 or 3300, put it that way, I will be on the short side. I'm almost universally, and this is something you can think about. When I see a big move, a big 161% golden fib extension off of what I consider a big reactive move, I will trade it. So like this was a big move. This is, and there's no doubt in my mind, this move was a huge move. Therefore, the 161% extension of this move, I will sell into. If it was like let me give you something different, like this little move here, this little pullback right here, for me to short into 161% extension of just a little consolidation like that, it's not imperative for me to do it. It's not something that I'm like, oh, I got to do it. I'm going to take that trade no matter what. This is if we get up here at 133 or 3,300, I will short no matter what. And I'll put it because I think it's good risk reward. Doesn't mean I'll make money, but that I will take the trade. And, again, do I think that we'll reach there? I'm hoping we will. I don't know if we will, but I'm really hoping we get up there. That would be, in my opinion, it would be awesome because that would allow that opportunity to be on the short side of the S&P and what I consider a good level. If we break through this this support down here, 3180 whatever, then I'll have to rethink how I want to attack that position personally, and that's it'll be a big question mark. Damn it. One of the I sold a little euro yen up here this morning because this is a double top. I sold, this is a double top and a retest of the double top, 38% retracement. So I sold some euro yen this morning. I kind of want to be more aggressive than I am, but it is Monday and it's the first full trading day of the year. So I don't want to be, first full trading week of the year. Let me put it that way. I don't want to be super aggressive yet. I kind of want to, feel out the market, see how we're, how we're responding at levels. But I did sell some euro yen above 121, near 121.10. So anyway, speaking of the euro, let's just go back to the euro dollar. So the euro dollar, again, if we can get down to 111.80, I am a buyer down there. The cable, I had a bid in the cable overnight at 130. I was hoping the opposite would have happened from last night. So we were here last night. And what I was hoping was going to happen is that we were going to dip down towards 130 and I was going to be a buyer down here. I have no idea what to do with the cable at current levels. I will say that overall, I am bullish the pound. I want to be long the pound. It's not a dire emergency that I get long the cable right now because there's no sense of urgency to be long the cable right at this moment in time. However, I do want to, from a macro standpoint, I do want to play the cable on the long side. So it's just trying to find a strategic, good entry level at this point. And down at 130 would have been good. Up here is not so good. So I'm leaving it alone. You talk about like the Aussie and the Kiwi. I'm scared of these currencies. We had a really good reaction in the Aussie off of this Gartley pattern. Really good reaction here. We had a very good reaction from this previous breakout point at this 69.30, and this is what I told you guys on the week ahead video is this is very pivotal right here. If you're an Aussie bull, this is the time you want to be long. If you're an Aussie bear, you're just waiting for a break of this trend line to go short. And if you're more agnostic, you could say, well, I'm just going to buy it down here. And then if it breaks through the trend line, I'm going to get short. You could do that as well. I'm just telling you that this area, as I stated in the week ahead video, this is a very pivotal area for the Aussie. I don't have any skin in the game, nor do I have any real opinion about it at this point. I just kind of want to see how we react from here. What I'm actually more interested in is not necessarily the Aussie dollar itself. I'm actually interested in the Euro Aussie. I think the Euro Aussie is a very good risk off barometer, which is, it's obviously higher today. You can see we have massive support through here. Massive support in the Euro Aussie down here. And I have it in my notes. If you guys were with me last week, I showed you guys a picture of my notebook. Here, if you guys want it, for those of you that missed it from last week. This is, my journal from, you can see this is my journal here from last week. You might actually be able to see, right? I'm looking at it to see. Now, I don't have Euro, Mexican peso, Euro dollar, pound dollar, Aussie yen, dollar max, Euro dollar. No, I don't see any of that. Anyway, as I told you guys last week, I'm being pretty diligent about journaling everything that I'm doing, which I really have gone away from the last few years. But last year's lack of volatility really encouraged me to to start doing a journal again, because the low volatility environment really has to force myself, and hopefully force you guys as well, to be a little bit more responsible for every trade that you take, to take accountability, And for me, it's one of those things. If I see it, if I do it, and also if I write it, it makes it that much more important. So if I write down, a certain level that is really important for me, it forges that, it reinforces it in my head. And one of the levels that I've been talking about in my journal is the Euro Aussie around this 160 level. I want to be long. I'm not long right now. I just wanted to be long, and I thought this was a really good base here. And when it broke out of that base over the weekend, so we gapped up over the weekend, I actually had a buy order to buy the Euro Aussie down here to get long. It just didn't happen overnight. It didn't transpire. But that's I am looking to play the Euro Aussie on the long side. So therefore, I guess if you take what I just said, I am looking for, I'm more bearish the Aussie. I expect the Aussie to break down. I am expecting the Euro to be a better long side trade and the Aussie to be better short side trade. So therefore, I would think that the Aussie would eventually break lower. I'm just this is just right now they're just setups, and being setups, I'm just trying to be very, very, very what's the word I'm looking for? It's so early in the morning here. Since I've been up since like 4, I'm looking to be just a little bit more diligent and waiting for my levels to come to me, rather than me chasing the market all over the place. This is one thing that I've learned, especially the end of last year, the last quarter, is you just can't chase the market. You have to let the market come to you. And so I'm just trying to be very patient and disciplined in allowing the market to come to me versus me chasing the market everywhere. I got a little caught up at the end of last year, trying to chase the market one direction or the other, and that cost me. It was my first down quarter in, I can't even tell you guys how long. And yes, I can point my finger at a low volatility environment, but I can also point my finger at myself and my lack of discipline and FOMOing my ass around the market, chasing the market in different directions based on, China trade, USMCA, blah, blah, blah. I really was a victim of fear of missing out. And I think that one thing that's helping me, what's helped me last week, I know it was a very, short week last week, but one thing that helped me last week and even today is just, letting the market come to me. So anyway, those are just some things that I'm thinking about. Oh, a couple last things before I asked Steve and Stelios. Or no, Stelios is not going to be here today. It is a Greek holiday. Steve doesn't care about no freaking holidays, so Steve is here, that's one of the amazing things about Steve. He's an animal. One of the things I did want to point out is the very strong move in gold. As you guys know, I've been very bullish and very I am not long gold right now, and I wasn't overnight, but I've been playing gold to the long side. I sold it when we hit the 618 right here at 1511, thinking I was a superstar. Here we are, much higher, and at the 127% extension of this flag. And keep in mind, guys, this flag, just so you guys know. Oops, shoot, I didn't want to do that. That was my fault. I clicked the wrong. I want to clone that. This flag points to 1700. That doesn't mean that we're going there today. Not at all. But that's where overall above 1700 would be ultimately where I think we're going. It just, obviously where we're currently at right now, you got to be a buyer on dips. And this is pretty clear to me now, now meaning today, what I would be doing if I was trading gold. If I was trading gold, I'd just be waiting for a dip down to the breakout point. So, the breakout point being 1556, 58, I think 56, 58, somewhere around there, right? 56. Let it dip below that. So let it get to like, 1550 or 1548. Let it,
I show it leaving a gap on the 15-minute chart around there, Blake.
yeah, it gapped higher over the weekend.
Yeah.
You know,
I think it fills it there around 1552 or something like that.
yeah, and honestly, I think we can, you know, you can let the market get back down there, and give you a better entry down there rather than chasing it up here. I may be completely wrong, and it could just blast higher. Like I said, I'm very bullish gold, very like it wouldn't surprise me if we just start ripping, but you know, that would be more geopolitical related from here. And that's something that unfortunately you and I don't have any control over. So, you know, it could be some massive cyber attack from Iran, or, you know, some
Retaliatory.
yes, thank you, measure from them that could push the gold market higher. And, you know, so for me to actually sit here and go, well, I'm just going to trade on the short side till we get down to 1550, that would be absolutely crazy, in my opinion, because you don't know what's going to happen. Chances are, you know, nothing's going to happen and it's going to drift back down towards 1550. But I wouldn't want to be on the short side because, you know, if something does happen, gold's going to rip right past 1600. So the way I'd play this, and the way I'm going to try to play it, is just wait for a dip in gold back to some level that I deem is more appropriate to be on the long side. But gold's very strong. Silver is not following. Silver is at the 618 retracement and is struggling. So what that typically will tell me is two things. A, it's risk off, which, you know, when gold outperforms silver, it's risk off. B, it also tells me that this precious metals move is not a sustainable move higher. In order for me to be really bullish precious metals at this moment, I'd have to see silver matching or exceeding gold's move, and which it's not. So does that mean that I'm bearish? No, I think that, you know, gold's upside is probably limited from here, rather than, oh, we're going to 1700 today. That I do not feel. So because I don't think gold's going up for the right reasons. I think it's going up for the, you know, the risk off reasons. So anyway, just some 2 cents about gold, silver, the FX. But let me mention something to you before I bring Steve on. Monday through Thursday, we do the daily Roundup webinar. So you'll catch me again 4 hours from now. All right, so let me say that slowly. 4 hours from now at 12:30 Eastern, you will catch me on the daily Roundup webinar. Paul Franco was hosting that. I'll be hosting it for the next month, 2, maybe 3, who knows. But I'm going to host it for a while. So you guys want to get my updated thoughts on the market 4 hours from now, tune in. It's free. And then also I'll kind of clue you guys in what I'm looking for going into Asian trade as well. So I'll catch you guys on the daily Roundup webinar, and it's only about 10 or 15 minutes long. So I'll see you then. Steve, how you doing, buddy?
Good morning.
Wait, hold on. Let me state this. FX Cole said, "Do you short gold then?" I think I just went through the whole reason why you can short gold. I ain't shorting gold. You short gold, and you know all you need is some event in Iran, some headline. Gold will be shoved so far up your rear end you won't even know what day it is. So rather than being on the short side of gold, you know, have a bias. Like for me, I'm bullish. I'd rather buy dips rather than, you know, I try not to play both sides of the market because I'm not that good. One thing that that's kept me alive for the last 20, almost 5 years trading the markets is realizing what my strengths and weaknesses are. My strength is knowing what my bias is and going with that. Trading both sides of the market is not my strength. So I'll let, you know, somebody with some bigger balls, maybe like you, to take advantage of that. All right, Steve. So what's up, man?
Good, good, Blake. I see. I find it interesting that the vast majority of the traders I see on. We just got some data, by the way. Let me check what it is. Oh, Canadian producer prices. Another disappointing print.
Oh crap! I forgot we had Canadian
Yeah,
CPI came out. I wasn't even
yeah.
paying attention. Well, there you go. But the Canadians at the 127% extension. You know what is a little surprising here with the strength in crude, that we haven't seen more Canadian strength. I'm surprised the dollar Canadian hasn't broken down yet. So I guess you can see we're coiling here. We might get a breakout soon. Anyway, well,
So yeah, a lot of people have been trying during the past few weeks to sort gold strength, and I do believe it's a very, very dangerous proposition. Of course, with daily RSI being at 87, yeah, it has to pull back at some point, right? I mean, nothing can go on indefinitely without a correction, but there is no question in my mind, as you said, and we've been saying that for quite some time, that people should be very, very careful, because I'm very, very bullish the metals. And, we don't only have geopolitical reasons that are pushing them higher. Most importantly, we have monetary reasons for pushing them higher, and central banks that have clearly stated that inflation has moved back to their priority list.
yeah.
So, there is no better hedge for inflation than gold. End of story.
That this is true, and we've been waiting for inflation for, I mean, I don't know how many years, but I actually do think 2020 there's probably the best shot that we have for higher inflationary data.
We
Anton
have
asked,
seen all that. We have seen all that inflation, but it's not yet so much in consumer prices. It is in asset prices. The thing is that once dollar turns lower, inevitably that will also translate to consumer prices inflation. So it's all a dollar function having to do
yeah,
with that. And I don't think dollar can keep on staying elevated forever, especially given the U.S. fiscal position.
right. Hey, Steve, can you answer this? I'm gonna get off to trading here, but Gautam asks, how can everybody access the daily Roundup webinar? Can you go through that for him?
Oh yeah, absolutely.
All right. Hey guys, have a great Dale. Have a great interview today with Mark Chandler. He's a friend of mine. Next time I'm in New York, I'm gonna try to hook up with him.
Yeah, one of the better minds in the FX industry.
If you guys haven't read his books, read his books. If you don't follow him on Twitter, you need to follow him. He's just a really, really great guy, and we chit chat every once in a while.
I love him.
He's like, come stay at my house. I'm like,
Oh, yeah?
I'm gonna take one of his kids that are off in college, their rooms or something. So anyway, I'll let you guys go. Have a great interview, Dale.
Thanks, man.
Steve, have a great one.
Thank you, Blake.
Right.
Thanks, guys.
GL today, bro.
Thanks.
Bye-bye, mate.
You too.
Hello, Steve. How are you, buddy?
Good. How have you been, Dale?
Good, good.
How was the weekend?
Good, but it seems surreal. It feels like the
Why?
world changed a little bit. Oh, just this black cloud that was created by taking out that general. I mean, I remember how it felt in the U.S. after 9/11. Everything, people, terror alert, orange, red, green, purple, all that stuff for years. And, people beside, it, there've been terror attacks. I mean, but not by Iran. I mean, you've had some lone wolves go into, places of worship and kill people, and, mass murders with automatic weapons. But, worries me because, like I said earlier, Steve, Iran with its proxies makes Al Qaeda look like a JV team.
No, I'm with you there, and I've mentioned multiple times in the past, and this is not a political position.
No.
I mean, having to do with parties, but I think that the U.S. politicians keep repeating the same mistakes, which is getting involved in in situations
Assassinations.
that they shouldn't be getting involved. I mean, the whole situation with the Middle East has been provoked over and over again since the 80s, and we know now, looking back, that the results have not been good, right? I mean, there was the incentive of oil and everything else, but at the end of the day, as a result of that, we've seen terrorism um, being substantially increased worldwide. We've seen the costs of that, both in monetary terms and reduced freedoms. And can you put a price to that? So I don't know. I think the best thing, and Trump as a candidate kept saying that, in his opinion, what the U.S. should do is, just move away from getting involved with Middle Eastern issues. And obviously that's not the
Well,
case now,
whether
right?
he's in office for another 10 months or another 4 years and 10 months, Ram will not go away now.
Yeah, I think so. Did you happen to watch, by the way, any clips of the
Golden
um,
Globes.
no, that was fun, actually. Yeah. Any clips of the Soleimani, or whatever he's called, like, funeral?
Oh yeah, massive,
I mean,
massive.
I've never seen such a crowd ever anywhere. It's unbelievable. I mean, everybody was in the streets, so not good news for sure. So let's hope that this can you know
It's like a
die
nuclear. It's kind of
die
like cross.
away
Oh
over the
yeah,
months without any
we
big
crossed the
consequences.
Rubicon.
Yeah, let's hope that's not the case.
Okay.
Let's hope that's not the case.
Anyway, let's make money. So you know,
Indeed.
So
Uh,
what do you think of the euro after last week? And I know your long-term bias. And I was thinking about, Steve. I don't know if you saw my opening, but you look at the monthly chart, and it's been one hell of a base from
yeah,
2015.
yeah.
And these recent lows at 108 are a higher low. And if you really get out the telescope, you know, I could see 120 euro, 125 euro.
Oh, I can very easily see that happening.
And that would just be a correction in a bear market, let alone if we're turning into a full-fledged bull. But a lot of money to be made between here and 124 if you time your entries and have your discipline and take partial profits. And you know you don't have to
you know,
trade 100 things. You could really just focus
you know,
on
there are there
the
are two
euro.
elements. There are two elements that the euro has against the USD that I like. Element number one, my medium to long term bias is bearish for the
Yeah.
dollar. Of course, we need to get confirmation, that this is manifesting, but I have no doubt it's going to happen. But we need to make sure that it's happening, right? And the second one is, still so many people can't even fathom a possible euro rally. I mean, the vast majority of the people are so bearish the euro that whenever I've seen that in the past, usually it turns out very ugly. I mean, when there is so much agreement on the direction of something, usually that's when you should be very, very cautious about being with the crowd.
Yeah.
And the crowd is very bearish the euro. So I think that people should be very careful with this, especially, I mean, and Blake
I
was.
think it's a trade of the year, Steve. People are, my buddies, you have friends that have been in the markets that you've been talking to for years, and you talk about, things and what you're thinking. And, I have a friend who keeps, looking for an S&P top and this and that. And I think, it may happen, it may not. I really think I won't use the word safe, but I think higher probability bets for 2020 are the short side of the dollar, and then just one more decline in yields and one more high in bonds and notes. And because of the dollar, I think the bond market's going to be more vulnerable, and the bond market could enter a bear market while the S&Ps could keep going. So I think whatever it is to keep the S&Ps going, and even, we'll have corrections, is that the easiest thing to do now, since they've tried everything else, is make the dollar the sacrificial lamb.
Yeah, it is. It is a likely scenario.
Yeah.
Blake was looking.
I mean, if the dollar broke 30%, but the markets were still levitating, no one would care until they go into the store and pay $5 for a loaf of bread. But you know what I mean? It would be disguised.
That is very, very true.
Yeah. Okay. Anyway, those are my thoughts in 2020 because
Blake was looking. I mean, he was looking for a reversal on Friday when we were at the lows, and that needed, guts, and we got that. You can see here the Euro USD actually retested that broken trend line and rebounded from there. So, I mean,
doing nothing wrong yet.
There isn't anything impressive to the upside having to do with momentum, but sometimes, as you know very well, turns can be very slow at the start before they actually accelerate.
I bet if you put a compass at the low on October and then started to draw a parabola, they always start slow, right?
Yeah, they always start
I kind
slow.
of like see a little bit of that developing here as the pullbacks get shallower and shallower. Do you kind of see how you could line up a compass on all these lows and get some type of arc?
No, yeah, of course. I see what you mean. Something like this.
Yeah.
Yeah, absolutely. Anyhow, against that trend line, there is nothing wrong with being bullish against this trend line, right? I mean, we retested it on a Friday. Very frequently we get much more frequently than statistics have mentioned that having to do with seasonality multiple times, you get lows or highs at the very beginning of the year or at the very, very end of the year. I mean, just by seeing what has happened with the euro specifically, for example, in 2019, we got the high of the year at 10th of January.
Yeah, look at that.
Now, if you go back to 2018, we got in January again, it would have been the high. We intraday, went over it just once, like intraday, in February. So as you see, it's nothing weird or peculiar to see a high or a low at the very first days of the year. Now somebody can say, okay, we might see the high of the year again in 2020. Yeah, it can happen. But as I said, for various reasons, I wouldn't want to be short the Euro USD. I actually like it a lot more to the upside than to the downside. And I'm just waiting for momentum to confirm because so far it hasn't. And having to do with the dollar, since you mentioned it, the dollar broke down from this channel. It came back. It retested it a couple of times. And seems quite heavy again. So I don't know. I think that the dollar is in danger of breaking down as well. So of course, those go hand in hand. I mean, if the dollar breaks down here, the dollar index, we know that it's very heavily skewed against the euro. So if one happens, the other will happen as well. So both of them show some promise in putting some continuation. But we have to remain very skeptical until we get confirmation. One thing is for sure, the crowd is still fighting this move, and this can actually make it accelerate once we see some signs that that's the case, because a lot of people will then have to do some position squaring, and that's going to move the market on its own.
Ben Maldonado brings up a good point when you talk about Iran, that You know, he's been on before, and he was talking
Oh,
about
I
an
see his comment
analog.
about the 70s. Yeah,
Yeah,
and the
yeah,
analog. Yeah,
79, I think it was. I'm pretty sure 79. So 2019, yeah, 40 years. Interesting. Thanks, Ben.
yeah, yeah, absolutely. And you know what else we had in
Nixon,
the 70s?
Nixon, and
And what else did
impeachment,
we have in the 70s?
stagflation.
Exactly,
Yeah.
exactly.
And that's
And
before Volcker came in and took rates to 20 to bring it
to
out.
20%, yeah, to 20% actually, yeah. Which,
Yeah.
you know, that's a problem now. The Fed
Can't bring it
was
out now.
the Fed was always pretending that if they saw inflation, they would vigorously act against it. Now
Yeah.
that inflation has actually reached and overshot their target because their target is core PCE and it's been hovering at roughly 2.3 for
Now
quite
it's
some
okay.
time.
They like it.
Now it's
Their
okay,
mandate. Yeah.
and they're pretending
Yeah.
that
They
they've
could
moved the
stop at any
goalposts
time
again.
without
Yeah,
getting
and they're
mentioned.
pretending
Yeah.
that they can stop at any time, but they can't
Yeah.
because we know that they're not going to admit it. But they view as their main mandate keeping the economy afloat. They know how much relying the economy is on asset prices. So in essence, it's like their main mandate has become keeping assets, stocks, real estate, etc., elevated. So you can't do that and fight inflation at the same time. You have to do one of the two if that happens, right? So, I mean, they've avoided facing the truth because we know that the inflation metrics are very, very skewed. They count, they underrate inflation, and still we have reached above their target, and now they're pretending it's not a problem. I think they will have to keep pretending even if the official number goes up to 3% or 3.5%. But as I've said, if there was one thing that was widely accepted by all central bankers until very recently is that you can't let the inflation genie out of the bottle because it's very hard to fight it, later on. So I do believe that there is a much bigger chance than the market expects to see that happening again in this decade as it happened in 1970s, and nobody's expecting and nobody is even preparing for it. And as I've mentioned, a long time ago, they're not even stress testing the banks for the possibility of stagflation. And in my opinion, the main reason they're not stress testing the banks for stagflation is the fact that there isn't a single bank that would pass the stress tests under such a scenario. If I remember right, even the most even under the most adverse scenario, they think that yields are going to stay more or less where they currently are. So they can't think of a financial environment where you have risk off and yields moving higher. They can't even, believe that's a possibility, and I think that's very dangerous. Now, just wanted to mention very fast that gold did test today a confluence of resistances. I remind you that 1586 was the 61.8 of the all-time high. So that's quite important. That was my target all along since we broke above there. And it's also the 127% extension of this corrective move. So I would be a little bit careful here. The only reason why I won't be sorting it as we speak is because I see a lot of people wanting to sort it. So as Blake said, there is the possibility that you can see another 1-2 big candles to the upside that will really take your scalp before it can actually turn lower, right? So I wouldn't be surprised to see even higher prices if we get some news, as Blake said. Now, having to do with silver, and then I'm going to go through your questions because we have a lot of questions and I've seen them all. Silver is also testing a resistance area, confluence of resistances here, the 61.8 and this horizontal support resistance area. You can see how many times in the past you can see how important this horizontal support resistance area is, right? That's why you need to keep the big picture in mind always as well. I mean, going back to 2013, look at this: support, 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 support once again for 3-4 days, and then it broke down. Then the first time we retest this area, it acts as resistance. Once we break above it, it acts as support. You can see how important anyhow this area is. So, you should also be careful with silver here. I mean, there is a decent probability that we're going to see a pullback there as well. But, I'm definitely bullish, both the metals. I wouldn't be buying them here, right? I mean, but, it is what it is. They may actually want inflation to depreciate the debt. Of course they want inflation to depreciate the debt. The thing is that they want inflation to depreciate the debt, but at the same time, they want that inflation to come as discreetly as possible, because they know that once citizens start realizing, how high inflation is, there's going to be an uprising. So trust me, they don't want inflation to actually explode, because then government, whichever government has inflation, is going to have a huge problem, and they don't want that either, right? So they want inflation to be higher than they measure, but they don't want it to go out of hand, because then there's going to be big political problems for whichever government. I mean, they will have to fight it, and once they have to fight it, they will have to force the economy to tank. So they don't want to come to that point, but they will. I think they will come to that crossroad, and they will have to make a decision. Gautam says, I agree with your longer term view, but fundamental developments of Fed balance sheet contraction. The Fed is actually inflating its balance sheet again with, quite an impressive pace. So, the balance.
I read something on Zero Hedge that they're going to drain some of that stuff now that they got past that choke point. So maybe that's what he's talking about.
Coach, I remind you that the last time the Fed actually spoke about their intention to actually reverse their monetary policy having to do with expanding the balance sheet was when Bernanke was testifying in front of Congress in 2009 to try to persuade them that what they're doing is not debt monetization, because it's going to be very short term. And
I don't even remember that.
It would be debt monetization if they intended to actually hold those in their balance sheet, but those are just measures taking in the short term.
Yeah, and they were going to roll them off,
salvage the economy, and they would immediately reverse them once the economy stabilized.
Immediately now, in 20 years.
Yeah, now we're like 11 years after that, and the Fed's balance sheet grew from 1 trillion to 4.5. It, in the short term, deflated down to 3.7, which is still almost 4 times what it was before they started inflating it in 2008. And we know now that there was nothing temporary with those measures. So you would allow me to be very, very skeptical with the possibility of contracting the balance sheet until I can actually see that happening. Because I'm very, very skeptical with what they promise, because in contrast with what they actually end up doing, the vast majority of the times what they promise they will be doing is, is far away from the truth. Balance sheet is going to adjust downwards due to temporary liquidity not being needed. Gautam, let's first see that happening, and we can have that discussion later, because as I said, I'm very, very skeptical.
It was a Zero Hedge article you read, right?
Yeah, okay. Okay. But let's see that happening first, and we can discuss that later on. So Euronoc, we have a question about Euronoc. Okay, Euronoc clearly remains under pressure, right? I mean, it held this very, very important trend line support. You can see this like huge wedge, but so far no real rebound. I mean, we've had 1 day of rebound. Today, earlier today, we saw a continuation higher, and we've already given back from the 200 daily moving average. We've already given back all our gains, and we're actually in negative territory. As you see, once we closed below this 200 DMA, we've tested it since 1, 2, 3, 4 days today. So we've tested it like 4 times within like what, 6, 7 trading days, and every single time we have failed. So, you know, I wouldn't be turning bullish as long as the 200 daily moving average is holding as a resistance. On the other hand, you know, would I be advocating for somebody to short it just above support? No, I was short since we broke down from there. So, you know, I have no problem holding still half of my Euro NOK short. But would I be shorting if I had no position here? No, I wouldn't. Right. I mean, we're very oversold in anything below the daily RSI. So, you know, I would be very skeptical. But so far, price action shows that we might just consolidate for a little while at the lows, and then we might continue lower. So I would be quite careful here. Now, if you want to be long, you have a very, very limited risk, right? You can, you know, place your stop like below these lows, let's say at 980, and you know you have a very limited risk. So it would make sense from a risk reward perspective if you want to be long. Now, will it work? I have no idea, but you know, risk reward is definitely there. You have a very important trend line. We developed that like tweezer bottom here, so it might work. Who knows? Personally, I'll still hold half of my short because if we make it through this trend line, I think we're going to see a lot more weakness coming through. Also, since you mentioned it and since we went there, USD NOK, more or less the same type of situation. We saw a reaction from the 61.8 and horizontal support area here. But, you know, Friday's price action has completely been reversed already today. So there is a big chance that the USD NOK is going to be continuing to the downsides. I'm still holding half of my position here as well. So, you know, I'm still looking forward for continuation. So far, crude is performing well, having, you know, since we had all this geopolitical risk coming through the market. Speaking of crude, I was very skeptical with the breakout, but you know the breakout did happen and it did accelerate due to the geopolitical reasons. We actually retested this broken trend line resistance and support, as you see, for a couple of days, and we've shot higher. Let's see if today we're going to manage to close above this 63.38 area and get ourselves a higher high on a closing basis as well. So, you know, against 61, I mean, I still don't like the momentum and everything else, but against 61, you know, it's very hard to advocate being short crude, right? I mean, you know, we've had a breakout. It is what it is. So I would rather, as I said some time ago, I would rather be long the metals than crude. And at least I was proven right in that because the metals have overperformed crude. But still, I mean, I would be very afraid to fade this move as long as we are above 61. So as long as crude is performing well, you know, NOK and CAD should be somewhat supported. I mean, the correlation is not that big as it used to be, but it still plays some role. And you know, the dollar is at the same time under pressure, so obviously that helps as well. Speaking of the Canadian, you know, it's noteworthy that the Canadian has not broken down, as Blake said. On the other hand, we have to consider the fact that Canadian data have been abysmal for quite some time. I have to say, though, on the other hand, that you know, USD CAD looks very, very weak. I mean, we've broken down from this recent range, and look at this consolidation. I mean, it's just a consolidation, right? So I think the chances are for a continuation lower here, despite the fact that we've had, weak Canadian data. The fact that the dollar remains under pressure and crude is doing well is enough to keep the pair under pressure. And I do think that there is a big chance that we might see a bigger move unfold from here. So I would be very, very careful trying to be long the USD CAD, at least as long as we remain below, let's say, 130.50. So below 130.50, I think that, the path of least resistance is actually lower.
Thanks, Steve.
My pleasure. Do we have an interview today, Coach?
Yes, Mark Chandler.
Oh, Mark is here. Okay, nice.
Yeah.
It's going to be very interesting to hear his thoughts. We definitely had a very interesting start of the year. Oh, one more thing. I know many of you don't watch them and I rarely trade them, but both Bitcoin and Ethereum
Trying to come out of here.
Look like they're attempting to break out
Mm-hmm.
from the equivalent formations. Actually, Ethereum is already making the move. Bitcoin is currently testing resistance. So I have to say that if for some reason you like cryptos, probably you want to be on alert because there might be a buying opportunity here. Now, I don't know for how long it's going to be good. And personally, as you know, I'd rather be buying, the real thing, which is the metals. But, there is a decent chance that cryptos are going to make a move here as well.
Yeah, just cover up the title of the chart.
Yeah,
All right, Steve?
trade the chart, yes.
Yeah, just forget. A chart is a chart is a chart.
As you know, I've done it in the past. I traded Ethereum.
And Ethereum led the way last year too before Bitcoin broke out.
It did.
So that's a good point.
So,
I remember we were both long last February.
Yeah, so I have to tell you that I might actually do it this year again.
You're going to do it right now because I'm going to interview Mark. So get long and start putting in your buy orders and.
Long like Donkey Kong.
Okay, buddy.
Okay, enjoy the interview.
Okay, Mark, I'm really excited to talk to you. It's always too long, and like I said on Twitter, you're one of my favorite guests. I think you're one of the better minds in this crazy world. So I'm just looking for you to, I thought I'd just, there you are. Okay, so I'm unmuting you now, Mark. And Steve, maybe you could unshare.
Done, Coach.
Great.
Thank you, buddy. Hiya, Mark.
Good morning.
Happy New Year, buddy.
Happy New Year. Hope this one's a good one for you.
You too, but and not just in the market, in every way for you and your family. Okay, so did you want to share your screen, or do you want me to be just showing the markets we're talking about?
Maybe, can you see this? If I put this up on my screen now?
You hit the green share button. You'll see it's on the drop-down menu. It's a green box.
Okay, let's see. I think this one will do it for us then. Let's see.
Yeah.
Yep, okay. So maybe just introduce this. So as some of you know, I've been following the foreign exchange market. Dale, I might be close to your age. I think that our paths crossed at the floor of the Chicago Merc back in the mid-'80s.
Yeah, I'm 66 now.
I was born in '61.
Oh, I see, you're just a punk.
Little kid to you.
But yeah, our paths did cross, and I've been following your work. I've read your books, Mark, and I've interviewed you for years. And what a great time of the year to get an assessment of what your views are, and with all these different cross currents happening, geo and overnight Fed funds rate, and what's happening now with a new ECB chairman. So tell us what's on your radar, buddy.
Yeah, so I want to show you this chart because I think that a lot of times I find there's a big difference. I began my career on the retail side and I moved over to the institutional side, and I think there's a big difference. And it's not just access to information or access to deeper pools of capital, but it's also how we go about thinking about things and the tools we use. And so while we always are trading individual currency pairs like dollar euro or euro NACI, like you were just talking about, the way to understand it from a policy making point of view and from an impact point of view is this chart I have for you here. This is the Federal Reserve's. You can see from the top of it. It's a trade weighted, real, which means it's adjusted for inflation, and it's broad, meaning it includes the bulk of U.S. trading partners. And I call this chart up because this is, I think, this is my roadmap.
Okay.
This is a picture of how the dollar's performed on real, adjusted for inflation against major trading partners since we went off of Bretton Woods back in the early 70s. And you can see how we've had these three rallies. As clear as the nose on my face, three big bounces.
Right.
And the first one we associate, so you can see that in the beginning of the 80s, and that's the Reagan rally, Reagan-Volcker rally. Fiscal policy was expanding with tax cuts, social spending, defense spending, and Paul Volcker, as you know, was stamping on the break of monetary policy. And that policy mix, tight monetary policy, loose fiscal policy, is the best policy mix for a currency. We get the Reagan-Volcker dollar rally. And then at the Plaza Hotel in 1985, G7 agreed the dollar had gone too far and intervened and drove it down. The dollar entered a 10-year bear market, and then we had the Clinton-Rubin dollar rally. And this is the high-tech bubble in the U.S., I should say the first one. Okay. And it was also Robert Rubin coming with the Treasury and announcing a strong dollar policy. And, you know, I see, you know, we still make fun of what the strong dollar policy means. And I always joke that, you know, we had a vice president who once said that a strong dollar policy meant that the dollar was difficult to counterfeit. It had nothing to do with its exchange rate.
Huh. What was that?
I also think the strong dollar policy meant is that at least from Rubin, until we could argue about these last couple of years, but from Rubin on, the U.S. has not used the dollar as a weapon. And that's what happened in '87 with the stock market crash. Yeah. Some people associate with James Baker at the Treasury threatening to let the dollar fall if Germany didn't stimulate its economy. And then this big low we had in mid-90s was when Lloyd Bentsen tried the same game on Japan, saying if Japan didn't, I think it was ease up on its auto trade with the U.S., that Lloyd Bentsen, would let the dollar fall. And so when Robert Rubin came in, he said, no, the U.S., the strong dollar meant that we, the U.S., would not purposely devalue the dollar to gain trade advantage or to reduce our debt burden. The market believed him. We went on a 10-year, roughly, bull market for the dollar. This is the Clinton-Rubin dollar rally. And then in October of 2000, Lawrence Summers was the Treasury Secretary at the time. And while we're buying Lucent and I remember Netscape as the IPO in this era. Yeah. And while we Americans kept our money at home, foreigners could not buy enough of U.S. equities. But Europe gave birth to the euro in these years and thought we were picking on the euro. And so they organized the intervention, which Summers, the U.S., participated in October of 2000, and drove the dollar down, drove the euro up. We went through another 10-year bear market for the dollar. And in the middle of the financial crisis, I think that the dollar bottomed and has begun rallying. And for me, the question is where we are now with this Obama-Trump dollar rally. I have been arguing since around the middle of last year that this dollar rally is about over. Maybe we can make a marginal new high, but I kind of think that we're rolling over, and in the period ahead of us, we should be looking for the dollar to weaken on this broad basis. Now, what's interesting about this, if I could stick this up here while we're watching it, is so I've got to use Bloomberg charts, but okay. I'm going to lay the euro over this. And I'm just going to take the inversion of the euro just because it's easier to do this. And there you can see how, even though the white line is that broad-based real trade dollar index, you can see how the euro, which is really Europe, is really the biggest U.S. trading partner as a whole. You can see how well the euro tracks this real broad trade-weighted dollar. So by being bearish on this broad trade-weighted dollar, it gives me insight that the euro is likely to get stronger. That is, as this is moving down, the dollar is getting weaker. And so this is my big framework. And some people say, well, why should the dollar get weaker? It's a key reserve currency. Europe's got negative interest rates. There's a whole like song and dance about why, after many people have only experienced this bull market for the dollar for the last decade, they say the dollar can't fall.
So
And
it takes 10 years for people to get amnesia. Huh, Mark? That's the way it seems here.
That's the way it seems. And I think that it's true too, I think, and I see this among short-term traders, is that the way we make money, we sort of get into this rut, buying dips or selling rallies or using this indicator or that indicator. And we're reluctant to give up our cash register, even though the markets may change. And so I think what happens is the markets change, and over time, we have to change our cash register or find a new job. And I think that that's where the market's at right now. I think we're at some crossroads. And here's an interest. So why do I think the dollar is going to come off? Maybe I can address that. Let me see if I can call up another chart here. Let's see. So go back
Also,
to
Mark, after the financial crisis, the beginning part of it, we had about a 30% depreciation of the dollar and about a 30% rally in S&Ps off the lows, and it's my contention it was nominal. Isn't the dollar the perfect sacrificial lamb right now for central planners to perhaps keep other asset prices up?
Yeah, no, I hear you, Dale.
Are
And
we
I
not
think that,
noticing? Go ahead.
yeah, I think that, I'm really pulled here because there's two ways to go here. One is that the secret cabal, if you will, this plunge, whatever the
the PPT,
the zero hedges of the world, like to think that there's a committee that really runs everything. And I kind of much more influenced by the Wizard of Oz. When you pull the curtain, there's nothing there. The wizard's a fraud. The central bankers, they might try to be planners. GM has a 5-year plan. Ford has a 5-year plan. Surely the government should have a 5-year plan. No one doubts about planning. I think the contribution of capitalism is decentralized planning, but the planners are not in control. I don't think that if they were in control, we would see these economic data that we've been seeing. They would like stronger growth.
Yeah.
They would like higher inflation.
Good point.
They would like lower. I just don't. So I know that there's this conspiracy theory out there that officials are really getting what they want here. I think that they are having to write the playbook as they play the game. And so I don't have the confidence that.
It reminds me of man plans and God laughs.
Yeah, I saw this funny cartoon along those lines. It had a guy carrying a sign that said, "The end is nigh. The end is nigh." And someone says to him, "Why are you so optimistic? This could last forever."
And it has so far.
And so for me, I'd say that the great financial crisis came as a big surprise, as a shock, and since then things have changed. So, for example, previously you're talking about how the central banks what they were doing with the Fed's balance sheet, and of course, but they went into it with expanding it. They said it wouldn't last very long. But we're finding that there's other things that have changed, like the demand for reserves, like the regulatory burden. So I don't think that Bernanke lied or Yellen lied. I think that the questions changed, the context changed. And I think that officials, for the most part, are true believers. I don't think that Bernanke went out of his way to mislead the market. Okay. I don't think Yellen does.
It's the invisible hand that's really running the show.
Yeah, but even that, I think that's like so confusing what the invisible hand is sometimes,
The market, people voting with their wallets.
Yeah, but it's only some people. So, for example, thinking about what the euro is going to do this year, you look at the futures market, and you'll see that the net position of speculators, our net position is short euros, but if you look at the bank's forecasts, you look at economists' forecasts, you look at analysts' forecasts, and they all have a stronger euro next year. And so it depends on voting and short-term traders, longer-term traders, and different influences. So I think the dollar is turning, but I'm not going to be convinced that we get a very sharp move. I think you might have been talking about 20% or something like that. I'm thinking that and this is why I love the currencies. Besides being the biggest of the capital markets, $6.6 trillion a day, you have to battle wits with all the players, central bankers, governments, hedge funds, asset managers like mutual funds, insurance companies, speculators, artificial intelligence. That's why I've always, even though I've been on this institutional side, my hat really goes off to people who have to eat what they hunt. Small speculators who are using their own money, not using other people's money, to try to battle wits. And so for me, it's a hard game, and that's why I've always had respect for those who live on their own hunting. And so I try to help by just identifying some of these fundamental forces. And the reason I have turned on the dollar after being bullish, my first book called Making Sense of the Dollar came out in 2009. It came out in August of 2009. And so you could appreciate it was in the heart of the financial crisis.
Right.
And I anticipated a long-term dollar rally. And I think that rally is over. And partly I look at the reasons that I think really fueled the bull market. First was the policy mix. The U.S. had a relatively tighter monetary policy, a loose fiscal policy. This is bullish for a currency. That policy mix is the opposite now. The Fed has eased policy the last 3 moves, and I think the next move is going to be another rate cut. I'm a little bit out of consensus here. I think there's going to be 2 rate cuts this year. Something like 14 of the 17 Fed officials say no cut will be necessary. After that week ISM before the weekend, the market is pricing in about an 80% chance of 1 cut. I think there'll be 2 cuts because I think the U.S. economy is losing momentum, and I think that it's hard to say that high-frequency data is important in the big picture, but I do think they can illustrate some themes, and I think they're going to see that with the non-farm payrolls this week. I'm looking for something around 160,000. I think that if you look at the 12-month moving average, it's steadily falling, and this is just a cyclical indicator. So we had a long but generally soft expansion, and I think that expansion is vulnerable, and I think that expansion is vulnerable in particular to the tightening of monetary policy. The loosening of monetary policy, the tightening of fiscal policy under the rubric of those tariffs. Okay. And I think the economy is slowing. And so for me, the policy mix is no longer supportive. And second thing, can you see this chart I stuck up here? This is the U.S.-German 2-year yield. Can you see that? Or do you still have the dollar?
No, I still have the real broad dollar, so I don't have the 2-year yield yet.
How do I get back to that?
You could stop. Okay, it just came up. You got it.
It just came up?
Oh, it came up, then it went away. So
let me try it again.
Okay. There it is.
There, you got it?
Yeah.
Yeah.
But when you try and don't try and increase the size of the window. It's big enough we could see it, because when you try and make it a full page, it goes away. So just leave it up, click it just at one time.
Yep, you can see it now?
Leave it. Yeah, we see it.
Okay, so this is the amazing thing here on this chart. This is looking at the 2-year interest rate differential between the U.S. and Germany. And you can see, I don't have it going back that far, but from 2015, we were about 50 basis points. We got up to 350 basis points at the end of 2018. Yeah. Look at the direction it's been moving, despite Europe having negative interest rates, despite the ECB easing. Look at what's happened. That interest rate differential has moved against the U.S. all of last year. Yeah. All of last year, from 350, so call it 215 today, but they call it 220 end of the year or something like that.
Okay. And
so for me, the 3 legs of the dollar's rally was, 1, interest rate differentials were moving in the U.S.'s favor. Now they're not.
Okay.
And I find that on the retail level, many people think in very linear terms. What level of interest rates equals some level of the euro-dollar exchange rate? But I think that what you'd find is that the more sophisticated or complex models are not so linear but cyclical. And so for me, I find that the last phase of a big dollar rally takes place as interest rate differentials are moving against it. It is as if the market is saying, we don't need such a good return on the asset because we have the dollar at our back.
Right.
And it worked.
Right.
And it works.
We didn't need the yield because the currency was
because the currency compensated.
Paying them. Yes.
Exactly. And that's what investors want, huh? They want, what we're really interested in is the total return. Right. Interest, capital gains, currency gains on those foreign assets. Right. And so this doesn't only work for the for Germany. This lines up very well for the UK, lines up very well for Japan as well. Interest rate, so the two legs of the dollar's rally, the policy mix no longer as supportive, interest rate differentials no longer as supportive. Now, when it comes to equities, everybody's got an idea what valuation is. Free cash flow, you look at PE ratios, you look at replacement costs, all kinds of different but generally agreed upon models. In foreign exchange, the closest thing we have is something like purchasing power parity. And here's what it's like. I was watching this, the mixed martial arts fights. My wife wasn't home one night. I was watching these fights, and what else are we going to do, right? And they said that this one guy who's smaller than me, he was supposed to be a lightweight, and they said pound for pound, he was the strongest man there was in the fighting. And pound for pound, that's what purchasing power parity is. It's like pound for pound. If China was pound for pound as big as the US, the RMB would be stronger, for example, or whatever the rule is. And so the idea is that it's not a that small guy, that mixed martial artist fighter, he was not stronger than the big guy, but if he weighed as much as the big guy would, sort of like an ant, an ant can lift 100 times its weight. Most of us humans, we're lucky if we can lift one times our weight. It doesn't mean an ant is really stronger than us.
Especially now. Anyway, yeah, go ahead, buddy.
But it's not like an ant is stronger than us, even though it can lift 100 times its weight, but pound for pound it is. And so I'm just trying to get to the idea that
great metaphor, really.
Yeah, purchasing power parity has to be, it's a tool that shouldn't be misused. If you're that small fighter, you're not going to go up and beat up or try to pick a fight with a big guy just because you pound for pound, you're stronger than him. Same thing in the currency. So valuation, this is one area where I think President Trump is spot on. The dollar, by almost any measure of purchasing power parity or some of its derivatives, cousins, if you will, they all show that the dollar is overvalued. And here's the interesting thing. Everybody's got their own model for it. I rather than reinvent the wheel, I'll just use the OECD's. And typically, the OECD currencies, these are the major currencies, Organization of Economic Cooperation and Development, they have their own purchasing power parity index. And the rubber band that connects spot to the value, or value to the exchange rate, how far it can move away from purchasing power parity? Usually 20 to 25%. The euro is about 24% undervalued. So
interesting.
We've lost the policy mix, interest rate differentials. The trajectory is moving against the U.S. and the dollar's overvalued by about as much as it gets against, say, the euro, the number one currency outside the dollar. So those three reasons, I think the dollar is rolling over. And then what I try to do is play in the short term. What does this mean? The clients at
as far as magnitude, everyone wants to know. Yeah. Well, okay, where could the euro go to, Mark?
Exactly.
Right?
Exactly. I think that people play in the magnitude, but here's the interesting thing I find is that the market, I like the market because of the diverse participation. And so I've spent my career helping the S&P 500 corporations, the largest asset managers, but I kind of thought that because of artificial intelligence, the rise of indexing, a macro guy like me wasn't adding as much value as I think I could to that part of the market, but they're not the whole market. These days, I'm helping small and medium-sized corporations at Bannockburn Global. And here's what it means, is that these large asset managers, maybe you should think about this for some of you are trading, thinking about the kind of spread that you pay between the bid and the offer. The large asset managers, the large corporations, on the euro, right, they're going to pay a thousandth of a penny spread between the bid and the offer. It's not just the 4 digits, but it's a 5th digit.
Yeah.
On the other side of the decimal point. Now, many small, medium-sized corporations are paying sometimes 3 to 4% spread between the bid and the offer. Now, I know for you traders, you're not paying that spread, 3 to 4%, but the spread is incredibly small, and just like in the rest of our lives, and that's what I like about what you do, Dale, is I think that you try to keep the trading and the markets within the context as a holistic approach, as who we are as people, what are the things that are going on. And the context, I think, is that the small pool of capital is always at a disadvantage. It's like watching those poker shows on TV. The small stack is at a disadvantage. And so I find I can help those small, medium-sized businesses who who are paying very wide spread between bid and the offer and bringing institutional knowledge to them. And it's sort of like in other parts of our life, we know when we buy something at a store, we're paying retail for it. And a lot of people, I don't think, appreciate that money works the same way. There's a wholesale price for money and a retail price for money. And if you don't know the difference, you're probably paying the retail.
Yeah. So, I mean, just that alone, that cost. So controlling of costs is an important thing that you're educating medium-sized, small-sized businesses with, because, you know, you have to, if they have to hedge 4 or 5 times a year, that's a lot of money.
It's a lot of money, and so I think that so the efficiency, market efficiency, and also what's the conclusion of all these indexing funds and all these asset managers? They do this trade cost analysis. When is the best time to trade? Well, it turns out the best time to trade is when everybody else is trading, which is basically the European afternoon, the U.S. morning. That's the most liquid part of the market. And that's when the spread, say, between the euro and the euro-dollar exchange rate gets the narrowest. As you go outside of the prime areas, the spreads can get wider. And this is especially true for those regional currencies, whether East Asia or even, you were talking before about euro NOK, dollar NOK, and even, I like Norway. I think Norway is, when I'm bullish on Europe, I get even more bullish on Norway. I think the macro fundamentals, very supportive. It's attractively priced currency. Part of the problem, though, is that it's not a deep market because there's not a lot of assets in Norway people want to buy. You have maybe an oil company, a couple of other companies, but for the most part,
Yeah, they do the buying. Don't they have one of the largest sovereign wealth funds on the planet?
Exactly, and so every month the gain there is not what's going on in Norway, or like say about. I think before, I think it was Steve was saying about how Canada's had some weak economic data. Yes, of course it's had some weak economic data. So has Japan, and look at Japan, 4-month highs on the yen today, and it's not because of the Japanese economy. It's because of how the yen fits into the world economy. I'd say the same thing partly about Canada. Canada is the only country right now that has a major country that's got the 2-year yield above the U.S. 2-year yield.
Interesting.
That affects like forwards, which affects corporations, which affects hedging. I think it should affect how we think about things. For me, it's a waterfalls. Canada is the first. But over time, that's why while I'm bullish on the euro, I'm not over the top bullish the euro. I think my year-end forecast is around 115 or 116 for the euro. It's not a big move, but it's the direction. And I'm waiting for better news from Europe. We had some decent PMI this morning, confirmation of the flash, more or less, a little bit more than the flash. But German manufacturing sector is still contracting. They've had some weak numbers, export numbers. Italy is important. So I'm really waiting for some better European news to gain some traction.
You know what we're waiting for, Mark? And I want to comment on yours from you. More volatility. You know, we're at record low volatility in many of these currencies. Last year, one of the lowest vol readings in euro and other currencies. Do you see that continuing, or is there a possibility that as the dollar rolls over, vol picks up?
Yeah, no, that's how I think about it, Dale, is volatility. I agree with you. It's low, but I know I know a lot of people who think it's, and in a short period of time, I often use the phrase too, like being compressed, like a spring coiling.
Yeah,
but it hasn't done that.
Yeah,
It sort of changes characteristic. And I do
it's
think
a string. It's like a slinky that's lost its spring.
yeah, huh? It's like stuck on that stair, huh?
Yeah,
And so I do think what do we need to see for volatility to pick up? We need to see it move out of this range that we've been in, say in the euro, call it 110, 112.
yeah.
109, 112, something like that. We need to break out of that. That's why I thought that's what the yen is telling us, or even sterling when we got to 135 on those exit polls when it was clear that the Tories were going to get that majority. Volatility jumped. And I think the dollar yen broke below 108 or below 108.50 or 108.30, whatever the key level was up there. That volatility has also picked up. So for me, so we think about volatility as a separate characteristic of the market, but I do think it's so directional, like the VIX. You tell me the S&Ps are gonna gap lower today, or about to gap lower, and I'd say, well, we're going to see jump up in the VIX. And so once we get outside the recent range, that's what I think gets the volatility going.
Okay. All right.
And it's directional. So a stronger euro for me right now probably will mean higher volatility in the currencies, but not the way it used to be. I think we're in a new paradigm of relatively low volatility in the capital markets, higher volatility in the underlying economies.
Anything on the geo front that comes into the mix for you?
Yeah, a couple of things. One is the markets, I think, always exaggerate geopolitical news, partly because many of us fancy ourselves to be either trained economists as undergraduates or graduates, or self-trained by the markets, so that they're like the College of Hard Knocks. But a lot of us,
Or
I
how about Nostra Pinkert?
think,
Can you see ourselves as a seer? Only a lot of times I get seared with my predictions. But what are you thinking, Mark? We're overblowing this. To me, it feels like we crossed the Rubicon a little bit with Iran here. So
yeah, no, I think there's so many times that I think we've crossed the Rubicon. And I mean,
it doesn't exist. We built a bridge on the Rubicon, then, huh?
Yeah, isn't that what happened? Do you remember when the Saudis oil facility was
Oh
attacked?
yeah, yeah.
Now this was a watershed.
Yeah.
Saudi homeland was being attacked, and so I kind of think that that the geopolitics is a mess, and it's not just Iran. Right now, Iran and Iraq. It's North Korea.
Yeah.
It's Libya Turkey going to Libya. It is.
Yeah.
It's what's going on in Venezuela today or last night. So I think that the world's a mess right now.
Yeah.
And
how about trade, Mark? Are you optimistic? I mean, phase one, does it mean anything to you? I remember last interview you said we're already in a cold war with China. That continues?
I still think we're in a cold war with China. What's funny is you got to these days, I'm beginning to read a little bit more of the South Morning China Post. And they have an interesting article in there today claiming that the Chinese were caught off guard when Trump went ahead with saying that they're going to sign this on January 15th. They hadn't even planned on coming here then. And that President Xi that Trump would go ahead of this, make a unilateral announcement, and even if President Xi wasn't available. And so it just tells me that the two sides, they might be talking every day or every other day or whatever the spin is. But
they're on different pages.
They're on different pages. And, it's like, having two people are talking, maybe it's the US and the UK, talk the same language, but they don't understand what each other is saying. And so I do think that this disengagement with China is going to continue. I think that we're going to be monitoring the trade flows, of course, seeing if they can make good on the $200 billion increase over the next couple of years. It sounds really important, but at the end of the day, I think that both sides are really like girding for a more sustained conflict. I think that China will see this with their CPI later this week. So they'll report a high CPI number, and take a look at the food. Food component is really what's lifting it, and there's a shortage of protein, and so a shortage of animal protein, pork and soy.
Yeah, right.
And so as they import more, the price can ease a little bit, and I think it's important to see that the PBOC eased over the New Year's,
right,
and it goes into effect today, and that despite the high inflation, because they can look past the high inflation and the headline level and really see the underlying inflation and PPI, the producer prices. The real threat in China is deflationary, not inflationary, despite this food prices. And the same thing with oil in the U.S. I point that out, really, a distinction here is in the U.S., we typically view higher oil prices as not inflationary. That's why the Fed spends so much time talking about core inflation.
Okay.
Higher oil prices means that the more it takes to heat your house, the more it takes
money you have.
Yes, less money you have for everything else.
Yeah.
So it's a relative price change, not a general price change. And for me, it's another one of those developments that fit into my sort of not recessionary, but weak growth this year in the U.S. Recessions in the U.S. tend to be preceded by an oil spike. And I think that's what's underway now.
Okay. What a great way to start the year, Mark. I wish you a great 2020 and that your work helps businesses that are trying to compete globally in this very challenging environment. I know that you'll give them an edge, and appreciate you being here and edifying us today, my trading warrior brother.
Thank you, and good luck, and good luck with your health.
Thank you so much, Mark. Everyone, that's Mark Chandler. You know, you could follow him at Mark Making Sense. Do you have a website now, Mark? Or
Yeah, my
anything like
website
that?
is, yeah, sure. It's my blog is Mark to Market.
Mark to Market.
Mark with a C.
Okay. All right, Mark. Well, Happy New Year, buddy. And really, I learned from you today. Thank you so much.
Thank you. Good luck to everybody.
Thank you, Mark. All right, that's a wrap for us today, guys. See everyone for Turnaround Tuesday. Don't just count your pips, count your blessings. We'll see what happens coming in for tomorrow. And looks like metals are coming off a bit here. And I really concur with Mark. We talked about it technically, and he certainly built a case fundamentally for us looking to buy dips in euro. So adios, everyone. See you tomorrow. Good hunting.